Hello everyone. I haven't posted for a long time in my channel, but it's 2026 and I think that's the perfect time to review all the changes I've made in my portfolio and how I see the state of the market. I'm Mehdi Photographer Mine, and in this video we are going to review all the different positions that I have in my portfolio and how I see them unfold in the next 3 to 5 years. So let's get started. So let's start with my biggest position in the portfolio. So as you can see, which is Alibaba. It is almost like 1/3 of the portfolio. It's actually a legacy position for me. It has been in the portfolio for many, many years now. And I still think that there is a lot of tailwinds behind Alibaba. The fact that they have been able to position themselves so well in terms of AI, so in China, and the fact that the Chinese economy is going to restart, and we are going to see actually a lot of enthusiasm, I think, in the coming years, especially in the Chinese equity market. So definitely, I think that Alibaba is still a very good opportunity, especially if you look at the way they are starting to monetize AI and how they are reinforcing their ecosystem, especially with the AI Quen app. So basically, this app is kind of the ChatGPT of China, and this is the number one app actually in the market, so in China. So great work for Alibaba, and this has been translated into their result for their cloud business. So their cloud business is actually growing almost as fast as the cloud business so in the US, which is actually a pretty big change if we compare to the previous years before, I would say, the AI wave. And we can definitely see Alibaba becoming more and more profitable going forward. And the fact that this AI app, Quen, is actually bringing a lot of synergies between all the different elements of Alibaba e-commerce is actually a huge plus for this tech giant in China. Having said that, so where do I see Alibaba going into the next 3 to 5 years? I think Alibaba is going to benefit both from the AI revolution and the Chinese economy resurgence. So definitely we are going to see Alibaba compound. Obviously also that they are going to invest. So I think that this is going to be, I would say, kind of a weight on their profitability in the short to mid term. So definitely they are going to have some kind of plays like Amazon where they're going to continue to invest behind AI and behind their e-commerce platform, especially on the instant commerce. I think that we have passed the peak of investment behind instant commerce, but definitely Alibaba is in an investment phase today. And so this is going to weigh on the profitability. But I think that in the next 3 to 5 years, I think Alibaba still presents a very huge opportunity at 150. In the next 5 years, they're definitely going to actually go back to their all-time highs, especially if the AI narrative is actually playing out, because today they are one of the leader, if not the leader of AI in China. And actually, contrary to a lot of companies in the US, they have been able to monetize AI and they are starting to continue to actually leverage everything that they have built in terms of AI to power both their e-commerce and cloud business. So great opportunity from Alibaba. So today it's 1/3 of the portfolio. I think that with time it's going to rebalance and it's going to become lower percentage in the portfolio, because I think that 1/3 is maybe a bit too much, but still a great opportunity for Alibaba. I think today at 150 Hong Kong dollars for so for the stock, I think that this is a good entry point. A lot of people say that it's a great entry point, but I would be a little bit reserved, especially on the short term, especially that the sentiment on Chinese equity today is quite, I would say, mixed. So that's why I'm still holding very strong all the shares that I have on Alibaba. And I think it's going to do very well as a position for my portfolio. Second position in my portfolio, and this is Amazon. So Amazon represents almost 19% of my portfolio. And I think that this is one of the biggest bet that I'm making, especially of the fact that AI, same as for Alibaba, is going to benefit tremendously logistics heavy companies like Amazon, especially with physical AI. So there are different narratives around Amazon always going around. So you have the retail narrative, the fact that the consumer is not spending anymore. So you have the tariff issues. But the reality, the retail business is going to benefit tremendously from AI, especially that in terms of margin, we are going to see margin expansion for Amazon business. This is something that we have said previously, but I think that this is going to actually be visible in the next quarters, definitely. And so it's going to benefit, I think, that in terms of the retail, but also as we have seen on the AWS business, because so we have seen AWS reaccelerating. There's a huge demand for compute. So in the US, so the three hyperscalers, so Microsoft, Google, and Amazon, they have been reaccelerating in terms of cloud business. So Amazon actually grew by plus 24% last quarter in terms of AWS and their cloud business. They have been saying that they are definitely supply constrained, and that's why they are investing almost $200 billion of capex. Um, but the thing is that they are not telling us what they are investing in, and I would suspect that actually they're not just investing for AWS, obviously, but there is a lot, I think, going on in terms of infrastructure for AI, but also for the chip business. And if we look at the chip business today with Trainium and Gravitron, I think it's going to be pretty significant for Amazon, especially if we are going into an era of we are more and more inference, and where inference actually leveraging more, I would say, CPU than GPUs. I think that all the experience that Amazon has had with CPU making and making chips like CPUs is going to play a huge role, I would say, for AWS. So basically, having said that and combining both narratives, or both, I would say, thesis, what we are seeing, and I think a lot of people are saying that. A lot of people are talking about the fact that Amazon is undervalued. Not a lot of people, I think, pinpoint the fact that the real play here is that Amazon is a play on margin. We are going to see that they're going to be more efficient for AI, and we're going to see that they are going to be more efficient in terms of retail. They're going to go after Costco. They're going to go after Walmart, definitely, especially if they can improve in terms of margin. This has been in their DNA since their creation, and I think it's going definitely to play out. And I think it's going to surprise a lot of people, especially on the retail side. On the AWS side, I think that they're going to benefit tremendously from cloud and all the workload and the compute that Anthropic is bringing to AWS, and we're going to see that play out in the next quarters. So, kind of funnily enough, I think that Amazon is a consensus contrarian bet today at $200, but I think it's going to play as an obvious play going forward because actually, like, there's a lot of opportunities and a lot of tailwind for Amazon going forward. So my next position on the portfolio at almost 15% is Google. So Google is actually the remaining of my initial position that I built when it was around $150. So actually, we nailed the fact that Google was an AI leader and a winner in terms of AI. So last year, so Google is performing very, very well for us. And this is the remaining of the position. So we have trimmed it a little bit, but still we are keeping in the portfolio, even though I think that today it is a little bit overvalued, especially if you compare to the other Mac 7, especially Meta, Microsoft, and Amazon. But Google, we keep it in the portfolio because we don't want to bet against the future, and we don't want to bet against the fact that Google has so many advantages in terms of AI that they're going to continue to dominate this field, and the fact that they have Google DeepMind, they have Waymo. There is so many opportunities for Google that I think that it should still be in the portfolio, and that they're going to continue to grow, and they're going to continue to actually surprise against all odds, especially in terms of AI. Every time we are seeing that they are bringing some new products and some basically great integration of AI into all the different products, and the fact that they have their TPUs and that they are much more efficient than a lot of different players, especially in terms of compute, I think it brings them a huge, I would say, advantage. And and as we have discussed with Amazon, I think the whole discussion today is about being efficient, especially with inference. We are going to see an explosion, and we are seeing that actually an explosion of inference. And I think that Google is going to be very well positioned with the TPU in the same way that Amazon is going to be very well positioned with their Trainium chips. Obviously, I think that NVIDIA is still or has still a part to play in all of that, but the fact that everybody is going to actually race toward efficiency in terms of inference because there is so much demand for all these AI services today. The players that are going to win are the players that really have been able to bring AI into all the different products in a very efficient way. And I think that this is what Amazon is going to do, and this is what Google is actually doing today with Gemini. I think that the work that they have been doing in the past 2 years is actually extraordinary. And that's why I don't want to bet against Google, and that's why it's still in the portfolio in a pretty sizable way today, actually. So next on the list is JD.com. So JD.com is actually also a remaining of the initial position that I had, and definitely it's a different type of play. So this is a value play on JD.com. So it has been underperforming in the past few months. This is needless to say. I think that it has not lived up, I would, in terms of stock price, to the expectation that I had for JD.com. But still, if you look at the valuation, JD.com is very, very undervalued. I think that people that don't um, give all the credit and the praise to J.com, which has been able to position itself very well into a niche for instant commerce. And I think that they're going to benefit as well from the resurgence of the Chinese economy going forward and in the next 5 years. My thesis, I think, is pretty simple. They are bringing back return to shareholders. So they have share buybacks. They have a 3% plus dividend yield. They are very cheap. Then they are going to continue to grow at very high single digit or even double digit if we see an acceleration in the Chinese recovery. And so basically, for me, J.com is actually a huge play for a 2x in the next 5 years, or even like much quicker given the valuation that it has today. So next in the portfolio, at almost 5% of the portfolio, so we have PayPal. So actually, PayPal was at a much bigger ratio in the portfolio before. So as you can see, um, I've s- I've actually sold most of my PayPal stocks after this Q4 earnings, which were actually disastrous. And I have to say that I was wrong on PayPal in the way that I thought that they would be able to actually stabilize the branded checkout, and they would reaccelerate on Venmo and on Braintree, where they have been reaccelerating very slightly. But the reason, or the main reason why I sold PayPal, or I actually kept a very small position, still 5% of the portfolio, is that basically PayPal has guided like decrease in EPS in 2026, which actually was very alarming for me. I think that they have not been able to actually deliver the promise that they have done with Alex Chris. And also the departure of Alex Chris was actually kind of a red flag for me. So today PayPal is in a wait and see situation. Obviously, it's a much better proposition today at $40 than it was at $65. I think it's a very, very different play today than it was a few months ago. So obviously, I was wrong in terms of timing. The reacceleration of growth has not materialized. The fact that they have not accelerated the buybacks in the fourth quarter, I think that this was almost criminal because the stock price keep dropping and they're not accelerating the buybacks. So I'm not sure exactly what they are looking for in terms of shareholder returns. I think this was a great opportunity, and even today, I think it's a even greater opportunity in terms of buyback. So I'm keeping PayPal in the portfolio because today I think it's way too cheap, and they are going to benefit, at least in terms of stock price, from a huge part of financial engineering. So it's also on a wait and see mode because I really want to see like how much they can return back to shareholders. I think in terms of business, well, Venmo is actually doing okay, Braintree as well, and they have a lot of, I would say, innovation as well with the stablecoin, the ads. Um, but today it has not really panned out that well. I think that they have and they had a lot of potential. But today I think that the fact that the brand checkout is clearly dying and clearly under attack. So I don't think that the business of PayPal is as strong as what was thinking before. So yes, today they have actually a strong free cash flow coming from the branded checkout, but we have to see like if they can maintain this free cash flow and what they're going to do going forward. Also, one of my fear with PayPal is that they're just going to be bought out, or they are just going to actually spin off like Venmo, for example, and this will be disastrous for all the shareholders, I think, because it means that you will not have any huge recovery. Um, So that's why PayPal still holds 5% allocation in the portfolio. I think that there's still some potential in PayPal into recovery in PayPal, especially at $40. I think that if they buy back enough shares, like we are at almost at a 15 or 16% yield today, well, they can definitely come back to $80 in the next 3 years. So I think that there is a play here, and that's why we are keeping PayPal. Next on the list is the Amazon of Latin America. So we added Mercado Libre. We really like the business of Mercado Libre, so the e-commerce business, but especially the fintech business of Mercado Libre. And I think that they're going to continue to grow and they're going to continue to compound in the very same way that Amazon has been doing in the past 20 years. So I think that they have the Amazon playbook. We already say that, and we are seeing that in the figures today. Mercado Libre is actually quite fairly priced. I would even say undervalued if you look at the price to free cash flow or the price to operating cash actually. And they have actually a very great business. And I think that they're going to compound going forward, and we can definitely see a double in the next 3 to 5 years, especially because the business is going to double in the next 3 to 5 years. So if they keep the same valuation that they have today and they continue to compound and continue to grow the business, I think that this is going to be a tremendous win for our portfolio. And I think that everybody investing today in Mercado Libre is making the right choice. So obviously, it's not financial advice exactly as for all the other picks, but I think that Mercado Libre is actually a great business. There's a lot of synergies between its Mercado Pago and its Mercado Libre platform. They have been able to build a huge infrastructure in terms of logistics in the same way Amazon has been doing. And I think that they're going to continue to dominate in both e-commerce, but more specifically in the fintech business, which is going to be much more margin accretive. Next on the list is BYD. So we have already done a video on BYD before, and I think that BYD is also going to be a huge candidate for a double in the next 3 to 5 years. Why? Because it's going to grow, especially outside of China. I think that they're going to be able to provide the world with affordable electric vehicle. So I think this is one thing. They're definitely going to be able to expand their revenue both in China and outside of China, and it's going to be extremely margin accretive for them to actually sell outside of China. So if we look in China, the rate is that a lot of different players, they are being really hurt by this price war. So I think that this isn't going to stop, and BYD is going to be able to maintain its margin in China and its market share. So I think that China is going to be kind of a mature market for them in terms of EV vehicle, especially that now they're going into the premium business more and more. So I think that they're going to be able to slightly improve margins or even better, given the execution excellence of BYD. And the real opportunity for BYD is actually export, meaning exporting their cars outside of China. And they're going to actually sell all type of cars, similar to what Toyota has been doing for the past 20, 30 years. I think that they're going to underprice a lot of competitors with much better cars. So in Europe, in Southeast Asia, in Africa, and in Latin America. I think that this is going to be huge. And also on top of that, they're going to bring premium vehicles. Um, I'm sure that in the US or like in Japan or in Europe, well, they are much more developed, I would say, car markets. Like they don't really care about that. But in Southeast Asia, Latin America, and Africa, I think is going to be a real actually change because like they don't really have all this opportunity to have I would say affordable luxury cars, and I think that BYD is going to dominate just in terms of logistics and in terms of price against all the different competitors. So that's one thesis for BYD. But there's also like another thesis, which is that BYD is going to benefit tremendously from physical AI as well. So I would say from robotics. So BYD has all this experience in terms of building so electric vehicle, and I think that the thesis is very similar to Tesla. And I don't know why, like, but people don't realize that they are very similar companies, and in the same way Tesla is going to actually um, have a huge business in terms of robotics, BYD is also going to have the opportunity to build the same type of robotics business. Not necessarily, I would say, in terms of humanoid robots, but definitely in their factories, they're going to automate a lot of things, and they're going to be able to actually provide also to other manufacturers. So this type of automation, and definitely is going to be a huge business as well for them. And on top of that, also, as you know, that they have their chip business, so they're going to be able to provide chip for automakers and for also for robot makers. So definitely, I think that there's a huge TAM and a huge opportunity for BYD going forward. And given the valuation that they have today at less than one time sales, definitely they are going to be able to double or even triple in the next 5 years. Next on the list is Brookfield at around 4% of the portfolio that I will group with Apollo because they have actually a similar thesis. So why Brookfield? I think that Brookfield should and deserve to have a much greater allocation in the portfolio. I'm trying to build that. I'm trying to make it bigger. Definitely why? Because as we mentioned already on this channel, so Brookfield Corporation has all the tailwinds that it needs to actually grow very significantly in the next 3 to 5 years. I think that they have positioned themselves very, very well in terms of helping the build out of AI infrastructure. So they have been able to provide the financing, they've been able to provide the resources in terms of power. So they're basically building like power plants or like power infrastructures for all the data centers build out. So actually, they are benefiting a lot from that, and they have been able to position themselves extremely well, especially in terms of AI sovereignty, where they are building data centers not only in the US but all around the world for different governments and also for the private sectors. So we have seen a lot of different deals already made with Microsoft, with Google, for example, with Nvidia. And definitely, I think that Brookfield Corporation is very, very well positioned. If you look at the investor presentation, yes, so they definitely guide like 15% plus returns or CAGR analyzed returns. Um, in the next 3 to 5 years. And I think that they're going to actually go much beyond that, especially if you consider all the carried interest that they have in all the different funds. I think that this is always um, not mentioned properly. But Brookfield Corporation, I think, is in a very, very well position to actually be able to actually to deliver great returns based on the AI build out and the fact that they have also alternatives outside of AI. They have also tailwinds in terms of retirement, for example. They have a tailwind in terms of private credits. Um, so definitely, I think that Brookfield Corporation is a huge pick and it should deserve a better allocation in my portfolio. And alongside Brookfield, so I've invested as well in Apollo Global Management. So Apollo is actually the best, I would say, in terms of private credit. So very similar to Brookfield Corporation. They have a lot of tailwinds. They have tailwinds in terms of, I would say, rebalancing between private and public in terms of equity, but in terms of credit as well. Um, they also have a huge challenge in terms of retirement. I think that there is a more and more retirement needs at the individual level, and I think that Apple is going to be able to provide a lot, especially with their Athene platforms. And finally, why Apple? Because I think that they are the best. I would say. Underwriter, especially for private credit. They have shown that in many, many instances. And there is a lot of needs for private credits, actually, especially in the AI build out, because there is a lot of need for funding, basically. And so I think that Apple is going to benefit tremendously, even though that on the short to midterm, so we are seeing this crisis of private credit because definitely what has happened in the field is that yes, it's a huge tailwind, meaning that there is a lot of demand for private credit. But what we have seen is that a lot of players they have not done their due diligence correctly, and what we are seeing today, especially with Blue Owl Capital, is that well, there's some kind of liquidity issues because not everything has been marked correctly. I would say in all these different funds, and sometimes it's a bit concerning seeing that. The way they are exiting all the different funds are selling the asset to themselves. So I think that some players are going to blow up definitely because they have not properly originated the deals. They have not properly chosen the different companies that they have been underwriting for. And so I think that Apollo is going to be hit a little bit by that, but at the end of the day, they are going to still be one of the best player in this industry. And I think that alongside Brookfield, um, I think that this is a great choice for anyone believing that private credit on the long term is going to actually benefit tremendously from all these tailwinds, especially coming from kind of industrial renaissance or industrial revolution, meaning that there is a lot of need for capital and that we're going to see more and more actually of these originations from the private side, especially given that on the banking side, like, they are kind of a bit shy, I would say, to go on these huge deals. But not every deal is going to be successful. But what we are betting on is that Apple is going to position themselves much better than the competition, and that the weak players are going to be wiped out, while strong players like Brookfield, KKR, Blackstone, and Apple are going to actually get out of this crisis much stronger and with much better position. So that's what I'm trying to position also in my portfolio, especially on Brookfield, KKR, and Apple, because I think that at the end of the day, in the next 3 to 5 years, they are very strong tailwinds and they're going to benefit tremendously. And now that the valuation has actually reset a little bit, especially for KKR, for example, I think that they are becoming more and more attractive. On the short term, there is no catalyst, I would say, especially for KKR and Apollo, especially for Apple, I would say, given the crisis we have today on the private credit. But I would say that there will be a time to accumulate, and that's what I've actually started to do with Apollo. I think it may take 6 months or 1 year, but definitely we are going to see in the next 3 to 5 years that they are going to demonstrate that they are going to benefit from these different tailwinds. First, because they are very good at execution, but also because they're going to benefit naturally from a lot of positive impacts from a lot of different tailwinds, as we said. Last position in the portfolio, and I'm going to be very quick. So it's Venture Global. So I've started a very small position in Venture Globals, and this is actually a play on the fact that there's still a lot of need for energy, and that LNG is going to be a huge part of the US strategy to actually provide energy to the world. So this is basically LNG exports, to be more precise, and the fact that Venture Global has a different approach, and the fact that they're going to become actually one of the biggest player in the field in the next 3 to 5 years. So that's why I think that this is a good play. This is a good actually bet. Um, I would prefer much lower prices today because the stock is very volatile. So I think that every time that the stock dip a little bit too much, I think it's a very great ad. And what we're going to see is that if there is a crisis and if LNG prices increase and BG is able to capital on that, yeah, I think that in the next 3 to 5 years that there's a lot of potential for a return to shoulders from VG. So I think that this is a good bet, but still a bet, and that's why it's a very small position today in the portfolio. So that's all for this presentation of this portfolio. So as you can see, I've tried to be as diversified as I could by still retaining some concentrated bets, even though I think it's still leaning a lot on the AI theme and the AI revolution, because I think this is what's going to drive the market in the next 3, 5, or even 10 years. And I think that we have to be positioned in the companies that are most likely to benefit from that. And what we have seen is that with Amazon, with Alibaba, Google, or Brookfield, they are going to naturally benefit from the AI build out and the fact that the whole society is going to change with AI. And I think that these are actually good bets because they will win in some ways in whatever condition we are seeing in the market. And so that's why they are much safer plays, because as infrastructure plays, they are positioned to benefit in most cases. If you enjoy this video and you would like some other analysis or comments about stocks, so you can subscribe to my channel, you can like this video, and I see you in another one. Bye.